This is Josh Jelinski with David Ranson. David is a legend in the world of economics. And David, for people who are not familiar with your work, describe your background.
Okay, well, it starts with being English. I came over to the US to graduate school, the Chicago Business School, and stayed. I never went back to England except to revisit my relatives. I've lived here ever since. All over the place, Washington, D.C. for some time. I was in the federal government when Nixon was president and worked for George Shultz and then William Simon. And since then, I've been with basically with one company. H.C. Wainwright & Co. was its original name, and we now call ourselves HCWE. So that's many decades in the same job as chief economist for Wainwright.
And describe your work with Milton Friedman.
Well, I was a graduate student when he was still teaching, and he was a stern teacher until you got to know him. And then he was a very gentle guy. And I did get to know him, and I really ended up loving the guy. He's a really nice person. I took several courses from him, tried to persuade him to be on my PhD committee, but he declined because he was in the economics department and I was in the business school. Maybe he had other reasons. But I got to know him pretty well, all the way nearly to the end of his life, and tried to persuade him in the last years of his life that the money supply wasn't doing the job that he had always argued that it would. So I'm not really a monetarist in the normal Friedmanite sense.
So for people who don't know what that means, what does that mean?
That means the quantity of money doesn't govern the inflation rate or the growth rate of the economy in the way that a lot of monetarists still argue even today. The relationship between money and the economy is quite more complicated than that. And money, if you want me to go on, I can go on all afternoon on this topic.
Yeah, let's. So monetarism is basically the belief, okay, if you have more money in circulation, dollars will be worth less. That we've heard that before. If you have less money in circulation, dollars will be more. What do you believe? And why do you think that that's wrong?
There are two sides to any market. In the case of money, one side, of course, is the suppliers of money, which include the banking system and the Federal Reserve. On the other side of the money market is the demand for money, the decisions that individuals like you and me and businesses make about how much money they want to hold. And I believe that at least in the short run, if not longer, the amount of money in circulation depends on how much money we want to hold, not on how much money has been supplied to us by the authorities. This is known as, by the way, I want to mention, this is known as the Mundelean. I don't want to take credit for this. This is the Mundelean view, which is equally valid as the Friedmanite view. The Friedman and Mundell just were the heads of two different schools of thought within monetarism.
Why do you think your view is correct?
Because, well, I have been looking at that quite recently. There's been a forecast not so long ago in the Wall Street Journal editorial page that since the M2 money supply has been declining in a way that it never declined in the past, that's a threat to the economy, and the economy is in serious trouble. My answer to that is that individuals who hold cash balances today have lots of reasons to reduce how much cash they want to hold. One of those reasons is inflation. The more inflation takes place, the less cash you want to hold, because cash is an idle asset and you're losing. The longer you hold the cash, the less it's worth. But the other reason, more relevant right now, is that growth causes individuals to hold less cash too, because growth symbolizes markets doing well, stocks particularly. So you don't want to have a large amount of cash balances when the economy is doing well and the stock market is doing well. You want to put your cash to work. So this is the demand side of the economy. So the higher the growth rate in the short run, the higher the growth rate, the less cash balance you want to hold. So there's an inverse correlation, which I think is the cause of this decline in M2 that a number of people are very concerned about.
So we've had you on in the past talking about, inflation, deflation. You were right when few others were. Frankly, a few years ago, 3 years ago, you called for persistent inflation. What is your take right now? What do you think will happen in the next 12 months on the inflation number?
Well, what's complicated the inflation picture is energy. The Russian invasion of Ukraine, and now again, another big scare in the Middle East, which is very energy sensitive. The thing that's happened is that uncertainty about the future of energy, and particularly from the point of view of the people who ultimately own all this oil, it's an investment for them, and there's more and more uncertainty about what will happen to their wealth as situations develop. So the more uncertain you are about the future of the oil industry, the less oil is worth. So that it's depressed the price of oil, and this depression in the price of oil has improved the inflation picture, causing everybody to think erroneously that the Fed has succeeded in reducing inflation. The Fed has nothing to do with it whatsoever. It's all an energy phenomenon. And the oil price is still way down there in around $72 a barrel. But I think the natural price of oil, if all of these war scares were to go away, would be around 130.
And if that happens, what happens to inflation? Shoots back up again.
It's a huge boost to the inflation rate. The inflation rate goes back to where it was before it started to alleviate. And beyond, in fact.
So you're in the camp that inflation is persistent for how long?
Until the government wakes up and follows different policies in the basically fiscal policy. As long as the government throws money at the economy, the inflation rate is going to go up. And I don't know how long it's going to take for the government to realize it can't afford to throw money at the economy in this way. All the politics are pushing the government to throw more money instead of less for a long, long time.
Have you looked at or interacted with Lacey Hunt and his view on disinflation? And what do you think about that? I guess you disagree with it, but.
Yeah, I know Lacey Hunt from many years ago, but I have not talked to him recently. So I couldn't tell you how his views might be different from mine. I think they are different. I'm not looking at the inflation situation anymore as a purely macro phenomenon. Energy is such an important commodity in the world economy, far more important than most people think it is, in fact, that it explains nearly all of the things that's been happening to the inflation rate recently. We don't need any macro arguments to explain it. But it does take some explaining as to why the oil price has done exactly what it's done and why it's so volatile. I can explain both to some extent, but the explanations are never quite deep enough.
Well, let's explain it.
Well, it's all about uncertainty. Let's look at the stock market as an analogy. Stocks are an investment, but they're a risky investment. So let's suppose there's a jump in uncertainty. Well, we had one when the COVID broke. The stock market goes down, but one of the things that goes up and explains why the market went down is the VIX index. I think people are quite familiar with the VIX index. It's an index of uncertainty, or more precisely, it's implied volatility, the uncertainty about the future return on stocks. So if VIX is up, that means more uncertainty. That means stocks are not worth what they were before. If they're more uncertain, they're worth less. The more uncertain you are, the less you value what you're looking at. So the stock market goes down. And indeed, if you look at the stock market from day to day, month to month, year to year, there's a huge inverse correlation between what happens to the VIX index and what happens to the stock market, the S&P. Well, now transfer to oil. Oil is not like stocks at all, but oil is an investment. Somebody has to own all the oil in the world. Not only the oil above ground, but even the oil that hasn't been released from the ground yet. It's all owned by somebody. So as uncertainty about the future of the oil industry increases, which it does when the Russians invade Ukraine or Hamas incurs into Israel, all of those things make the future of oil and energy in general more uncertain. And this uncertainty makes the value of an investment in the oil industry worth less. So that pulls oil prices down. This is counterintuitive to a lot of people, but it happened both times, both in March, I think it was, in 2022, when Russia invaded Ukraine. There was a temporary increase in the price of oil, but a longer-term major downturn. And the same thing happened again after October the 7th, a minor increase in the price of oil, followed by a major decline. And that's what happens to risky assets when they become more uncertain.
Why are they falling? Because governments...
Uncertainty.
No, but is there any truth to, okay, Biden going into an election year, you had Russia, Ukraine, you had people complaining that gas was too high in the U.S., so then they opened up the reserves or anything like that? I'm not an oil expert, but just...
No, I'm not either. No, there are dozens of explanations along the lines of strategic petroleum reserve, Saudi government policy, Russian export policy, Chinese import policy, Indian import policy, all sorts of variables. You can watch them all the time, and lots of oil analysts do. But I can't see how you could systematically get any kind of theory out of it, any kind of predictive ability.
You're not even saying why oil is low. Oil is just low, and that is stifling the rate of inflation. Why is that? What evidence do you have for that? Why is oil the one reason inflation is cooled? Just a formula?
Well, there's a couple of questions there. I think I mentioned the VIX index. The corresponding index for oil is called OVX. You can actually buy it and sell it. It's a financial instrument. It's called the implied volatility of the oil market. And it's well known that it reflects the uncertainty about future oil prices, or the uncertainty about the return on holding an oil-related investment. So that's why oil prices are depressed, because the uncertainty is much higher than it was. Just as we see the stock market depressed when VIX is much higher than usual. The normal level of VIX is 15 or so. It can get to a high of 30 or 40 or 50. It has even gotten as high as 60 or 70, I think, on occasion. Those are extreme examples of uncertainty that occur when there's a major geopolitical event, such as shooting down an American plane in the Middle East or something like that.
So oil's low, inflation's low. Where do you get your argument that inflation is persistent? And I know you've used this gold ratio and things like that in the past. I don't know if that tells us anything.
Yes, well, the ratio between oil and gold over the long haul is very, very stable. It's hardly any different today than it was 100 years ago, in spite of all the enormous changes that have taken place in the past 100 years in both the industry for oil and the gold market. All of that, it's a matter of the demand for these investments. People feel about these investments, their safety or their lack of safety, in the same way today as they did 100 years ago. And the result is that the ratio in price between oil and gold is much the same, very nearly the same as it was 100 years ago. And it's been the same all the way through, with these fluctuations, which are very confusing. And we're going through a fluctuation at the moment. But the fluctuations are always temporary. All of this is about the short run and the tendency for the short run to iron out. But in the long run, we see large increases, not in a stable, consistent way, but large jumps from time to time in both the price of oil and the price of gold, and of course in the prices of all the other commodities in the system. But the biggest jump that ever took place was after the Bretton Woods system broke down, and we went from a quasi gold standard in the old days to a floating standard without it, not really a standard at all. But the value of a dollar depends on what we think the Fed is going to do, which is a very poor basis for a currency.
What do you think? When will the Fed wake up and say, "Hey, you know what? We haven't, now they have a victory lap because inflation's cooling and they're talking about rate cuts and all these things." You believe that they are wrong and misguided. correct? And why is that?
In praise of the Fed, I would say they've been very cautious. And I wouldn't call it a victory lap. It's the people who kind of follow the Fed and believe in the Fed. They're the ones who are doing the victory lap. The Fed is very cautious and very reluctant to reduce interest rates. And it possibly never will reduce interest rates. That is still a possibility. It all depends on how things work out. So I have to say that in favor of the Fed, they're not being stupid, but they are missing this important insight. Two insights. One is that in the end, inflation depends on the depreciation of the dollar relative to gold. We've proved that over and over again, and the lapse of Bretton Woods was one of the major proofs. Other countries have proved it even more times on a larger scale. And then secondly, in the short run, we have the energy industry, which plays a much bigger role in the setting of the price level than anything the Fed is doing.
And so with inflation, what other proofs do you have for the fact that you think inflation will be persistent? And when do they wake up and say, hey, we were wrong, we have to keep hiking rates?
The basis of it is a very strong correlation over time with a bit of a lag in it between the price of gold and the price level. Consumer price index or the producer price index, there are lots of ways to measure that. As long as the gold price goes up in a very consistent way, which it is doing, the inflation rate will be consistent as well. Now, to complicate things, we can't use the spot price of gold to measure this because the spot price of gold is influenced by crises like COVID. That was one of the biggest crises recently. You need to look at gold 20 years out in the forward markets to be able to see what's happening to the depreciation of the dollar. But it's the depreciation of the dollar that is consistent over time, although it comes in jerks and cycles and waves, but it's still very consistent over time throughout nearly the whole world, not just in the US. And this gives you persistent inflation. But since Reagan, we had a break. Reagan broke the cycle in the 1980s. He campaigned to bring back the gold standard, and he followed very counter-liberal fiscal policies. And this encouraged people to have more confidence in the future of the dollar, and that stabilized the inflation rate. And the influence of Reagan has remained in the markets almost to the present time. But I think in 2020, it broke.
And so the future price of gold, you have this ratio that you look at that's the futures market, and you divide it by the strips. Remind me that again?
Yes, well, strips are just a way to estimate what the price 20 years out or 30 years out would be if we had an active gold market out there. The gold market isn't active, of course, for 30-year delivery. Who wants that? But you can, in finance, you can always create a price that for a hypothetical transaction, and that's what it would be. If you were buying and selling gold, and you're not required to deliver as seller to the demander until 20 years from now, there's still a price you agree on today. That price is the forward price, or you might call it a futures price. That is the price that I think measures the value or the extent to which the dollar has depreciated today. The markets are setting it for all the way out to the future, 20, 30 years, even beyond.
And what do I look at? I think in the past you've said look at is it the S&P U.S. Treasury Principal Strips Index or the Bank of America Merrill Lynch Long Treasury Principal Strips Index?
The one I use is the Bank of America Merrill Lynch. It was originally the Merrill Lynch database, and their figures for Treasury strips, that would be a bond that pays a balloon payment 30 years from now or 20 years from now, but pays no coupons in between. So it's called a zero coupon bond.
So what is it priced today?
Oh, I can't remember the numerical price. It's expressed in 6 digits. I'd have to look it up. But I'm interested in not what the level of the price is. What's important is the percentage change in the price. And I can tell you something about that.
And what is that saying?
Well, it's been rising at a fairly hefty rate all this year, all last year, 2023, and it's stabilized just in the last couple of months, since about November. The magnitude of it, if you measure it relative to when it was last stable back in 2020, about the time of the last presidential election, inflation was stable, and then suddenly in the new year, 2021, it took off. If you measure it relative to that, it's up 160%.
And how much is it up since January 2023?
About, I'd have to look it up. I've got a graph here, but I don't know if I can tell you exactly. On an index basis, it was about 170 at the beginning of 2023. It's at 270 at the end of 2023. So 170 to 270, that's a very hefty percentage increase just in 1 year. That's the real source of inflation that we aren't feeling yet.
Is it forward looking? So it is pricing in future inflation?
Yes, that's exactly what it's doing. It's a measure of how much inflation the markets collectively expect over the next 30 years.
I had this guy on 4 years ago, he was talking about what inflation would do in 2020 to 2023. People laughed at him, and he was like spot on correct. And what ended up happening on the basis of this very strange ratio. What do you call this? It's the ICE Bank of America long U.S. Treasury Principal Strips Index, and you divide that into the price of gold?
Yes, it's the price of gold, which is dollars per ounce, divided by ICEs, stands for Intercontinental Exchange. The price of a zero is the number of future dollars 30 years out or 20 years out you would get for a single dollar today. So you're dividing by today's dollars, and you end up with the ratio between gold and future dollars. And that's a much more stable basis for estimating the danger of inflation. It doesn't fluctuate the way the spot price of gold does.
And that is saying, based on last year, there's something like a 58% increase yet to be realized in the inflation rate?
Yeah, at least.
Yeah, and I remember you saying this 3 years ago to me, and it was like, I remember that like 160% increase that it was forecasting. And if you think about it, it kind of came true.
Well, only part of it has come true yet. And we think it's going in the opposite direction, but we are being misled. Energy is pushing it in the opposite direction, but only in the short run. The price of energy is also dictated by the price of gold historically, and that's very easy to prove.
Don't the Fed, don't they know this? Are they like purposely misleading people, or are they just happy that the price of energy is down?
That's a hard question to answer. They're absolutely not lacking in intelligence. They're not lacking in data. They're not lacking in insight, but they're looking in a completely different direction. So they're not seeing any of it, as far as I can tell.
How long have you been tracking this index? It's such a strange formula. How'd you come up with this?
Yeah, I stumbled on it. It wasn't anything I could construct. I just discovered it. I stumbled over it. About 5 years.
So I'm still trying to look and find this index.
The zero is on the internet.
Is it ZROZ? Is that the symbol, ZROZ?
No, the symbol in the database we talked about, which originally is Merrill Lynch, it's called ICE. The symbol for the 30-year Treasury strip is S030. And there's a 20-year and a 25-year and so forth, but I'm using the 30 for most of the time.
Oh, I got it. Okay, I see it now. Basically, the only thing holding inflation down, in your opinion, is the energy price being low. And eventually we're going to wake up, realize the Fed's wrong. And I mean, this actually is kind of a very bearish prediction, I have no reason to doubt you because the last 3 years I've had you on, or 4 years, this indicator has actually been very prescient when other people. So you do not adhere to the disinflation camp that we're going to have this deflationary environment at all?
Not at all. And people mix up the concept of deflation with depression, but they're not related at all. Deflation is simply a decline in the price level, but we'll probably never see that. Disinflation is a reduction in the rate at which the price level declines, and we have been seeing that for the last year, and that's driven by energy prices being so low, as I said. In the longer run, of course, there's a much more consistent tendency to have a positive rate at which prices rise. And in some countries, they can go all the way to hyperinflation, not at all uncommon anymore. And the US is not immune from that process. All you have to do is mismanage your monetary system, and you'll get hyperinflation for sure. It doesn't matter if you're US, UK, European, African, and so forth. It doesn't make any difference. It's a matter of the policies you follow.
When do you think they wake up and realize they got to raise rates again?
These are not people who are likely to wake up. They're absolutely committed to their thinking. Their doctrine is the only word to use. It's like religion. And I mean, how long did it take the Christianity to wake up from the Middle Ages to the present time? And how many people were killed in the process of quarreling over little bits of doctrine? It takes a very long time for people in an elite's control over the economy or over the country to change their minds. The doctrine passes from generation to generation to generation. It's a very, very long process.
So you're not an advocate. You don't believe that we'll have a soft landing then?
No, we never had to worry about a soft landing because we're not going to have a recession in the first place. And we haven't had a recession. I anticipated there wouldn't be a recession because there's been no big shock, and you need a big shock to get a recession. So what we've had is poor growth. We occasionally have a good quarter, but it doesn't mean very much. On the average, our growth rate is only about 1%. In the rest of the world, it's worse.
But if the collective belief, I don't share this belief, but if the collective belief is that the Fed sort of has its act together, they're going to do this soft landing, and all of a sudden they got to raise rates to prevent a further inflation, then the markets will get spooked. Next year or the year after, we might have another 20 to 30% drawdown.
I don't know to what extent the markets really believe what the Fed says. Where individual members of the market believe it, but the markets are really not driven by the opinions of individual people. They're driven by buying and selling decisions and people learning from experience, not necessarily just following what they learned in school. So the markets have a superior kind of intelligence, and you never know what they're going to do.
But don't you see that the market, do you have a question, Nick? Go ahead.
My question, and therefore implying, I guess that, inflation's coming back and oil is central to human civilization and it's artificially depressed. And when it goes back up, the inflation rate's going to go back up. All this makes sense. But what doesn't make sense to me is that the Federal Reserve can ever really allow interest rates to obtain a market level when the debt to GDP is so high and interest on the debt is, maybe just top defense and is headed for Social Security and will overtake Medicare as the single largest item in the federal budget. So in that sense, it seems like they have to, pull out the Japanese playbook and have yield curve control and artificially depress interest rates. And this last 2 years, 18 months is sort of a head fake before they have to capitulate. And can you really be Japan when you're the global world reserve currency?
I don't know anything about Japan. There isn't time to follow so many countries. I have to follow one or two or three. I couldn't answer the question about Japan. I do think that, well, I don't know where to start. The Fed has no, in my opinion, it's a myth to think you can control the yield curve. The Fed and other central banks do manage to control short-term interest rates. They were able to push them below zero in Germany and other places. But long-term interest rates, the evidence primarily suggests they had very little effect on those. It's two different worlds. The long-term bond markets are driven by markets. The short-term interest rate is an administrative thing that the central bank can control. Even there's a market influence. The markets are dominant throughout the whole thing, and markets recognize the threat of inflation, whether the Fed does or not, and they will price it. They'll price the dollar appropriately. They'll price the euro relative to the dollar according to that as well, and they'll price the future dollar 30 years out according to expectations. It's all driven by markets, not at all by central banks.
Well, the example in Japan was where they took their long rates and pegged them at 25 basis points because the Japanese debt to GDP is like 250%, and they just can't afford to pay anything higher than that. And then that broke, recently, and now it's at 50 basis points. So at some point, a country goes bankrupt because debt service at a market rate absorbs all tax revenue. And so that's where, even though, the yield curve, obviously the Fed doesn't control long rates in the historical paradigm, but this is what the Japanese had to do. They had to, expand their, their purview and control long rates because their debt was too high. So the concern is that a country like the United States can't really afford a market rate. Listen, I'll step down, and I appreciate.
There is an important point, an important insight to add to your question or to any answer I might give. Japan and the US are not the same kind of economy. In the main thing about the US, it's different from every other country in the world, perhaps except Russia. But the US government owns about 1/3 of all the land area. I think it's 1/3 of all the land area of the United States. It just owns it outright. And the amount of wealth vested in that is an enormous asset on the balance sheet of the federal government. So liabilities of the federal government can go much higher in the US than they could in any other country in the world. So the US is not in the same danger of bankruptcy that other countries are when their spending gets out of control. It's still a major problem. I'm not minimizing it, but the federal government doesn't have to worry about bankruptcy. If it sold all that land, it would be awash in wealth.
So let's go back to your question, your comments on oil. You call for one of your latest HCWE, and you can find out more of Dr. Ranson's work on hcwe.com. Talk about oil being 120 a barrel. You think that will be the normalization of the oil markets? Just is that based on like the long-term historical average or what?
Yes, if you look back 100 years, you find that the ratio between oil and gold forward, 20 years gold, and you could do this with spot gold if you want, it doesn't make any difference. It was the same as it's been in the last 2 or 3 years here. So over 100 years, it varies over time, but it always goes back to what it was before. It's called norm reverting, or some people call it mean reverting. So there's a permanence to the ratio between oil and gold, which is not going to go away. And that's the basis of figuring that the oil price should not be $72 a barrel right now. If things were normal, if we went back to the normal ratio with gold, it would be at least 120. maybe 130.
Okay, we're going to go to another question from Tina in the audience. Go ahead, Tina.
Apologize for that. Do you mind going over what your inflation formula is again? And can I find that on TradingView? Because that's really the only tool I have to try to look at a graph of this. I don't have a Bloomberg.
Let me make this a general comment. Make a note of my email address. Anyone is invited to write to me and ask for anything specific. The graph I would answer this with is one of my graphs. If you look at the cumulative inflation of a lot of countries around the world, especially the ones with the highest inflation rates, which tend to be in the undeveloped world, and plot that set of numbers against the cumulative rise in the price of gold in each country measured in their local currency, you get a straight line, a beautiful straight line and a slope of 45 degrees. So that graph is something I would love to make better known, because I don't see a lot of economists being aware of it. It's partly because they don't go back far enough into the past to see it. People have too short a time horizon. But a lot of my work depends on long time horizons, and there's a lot of insights to be found by looking at, in this case, this would be a 30-year inflation rate and a 30-year gold price change. So I would suggest to you that that's the best way to prove beyond any reasonable doubt that inflation results from the depreciation of the currency relative to a constant standard, the closest to which we can think of any asset would be gold.
Well, I'm curious. I'm in my early 60s, and I remember the price of gold throughout the 80s and the 90s and the 2000s. And I remember when the price of gold in 1998 was in the neighborhood of $200, $250 is where it bottomed. I'm a little confused at how that's plotting the historic. You're saying that as you go, I don't quite understand what you're describing, really. When you say, I only to begin with, I only care about the United States. I don't care, like you said. I'm not worried about all these other countries. Mostly, what I'm trading are U.S. assets. So I'm not super concerned about what inflation looks like in Argentina or Zimbabwe or lots of other places. So how would I calculate what you're talking about using market indicators like the price of gold?
I suggest that you can learn a lot from foreign countries, because many foreign countries have visited terrain that we have not yet. And it's not relevant to your investments. I agree with that. Yeah. Well, you can put the US on the same graph. My graph doesn't happen to include the US because I'm looking at inflation rates that are pretty violent in some cases. But the US fits right in the middle of this straight line 45-degree plot.
So how do I go about doing it? What I'm saying is I don't care what inflation does in other countries. I'm trading the S&P 500. I'm trading the NDX. I'm trading US bonds. It's irrelevant to me what inflation is doing in Russia or China or any of these other places. I don't care about it because I'm not trading those assets.
Well, you can see it by, if you insist, you can ignore all the other countries. Just look at the US, look at the price of gold in 1800 and the price level for consumers in 1800. Look at it in 2020, say. How many years is that? 220 years. You'll find that the percentage increase in both is essentially the same.
Well, no, let's just look at more recent history. If you look at 2020, and when I've had David on every 6 months, once a year, a couple times a year, it's just the ratio. If you're plotting gold, you take the price of gold, you divide that into the ICE 30-year strip number.
You don't even need, for this purpose, you don't even need to bother with that. Just use spot gold, and because over time, gold and the adjusted price of gold end up being in the same place. They over time, they are the same thing. But in the short run, they're not, which is why I think it's important to make the distinction. But it's so simple. Any time in the past, just take the price of gold in dollars and take the producer price index. That would be the best one to use because consumer price indexes are really screwed up. And look at today's version of the price of gold and the consumer or producer price index, and look at the percentage change in both. You'll find no matter which year you choose in the past, it's the same ratio. It isn't exactly the same every year, but if you allow for a lag between the price of gold and the producer price index, then you don't need much of a lag. You'll find it's the same. If you use the consumer price index, which nearly everybody insists on using, it's a longer lag, but it's still the same in the end.
Well, I think it's just gold. What the price of gold, 2050, right, or whatever it is, divided by S030 on the ICE exchange, which you have to subscribe to. I don't know, Tina, if it's. I mean, I've always tried to look this up when we have them on, and it's the ICE B of A. I think you got to subscribe to their feed, their data. But it's just but just simply, it's 20. It's if the price of gold's 2050 today, it's 2050 divided by the ICE Bank of America 30-year strips index, correct? And that will give you a number. Then you basically just plot that number every day and you see a rate of change. And I will tell you just from observing this since I've known David, it has been shockingly prescient of the last, 5 years I've known him. And it's given some forward. I mean, nothing's perfect. No indicator's perfect. It's given some forward-looking data where love Dr. Hunt and all those guys, but a lot of people are predicting disinflation, which we're seeing. Then in a year or two, then they're surprised when, prices jumped and stuff like that. So I found it to be an interesting indicator. I wish it was, to your point, Tina, I wish, hopefully, Dr. Ranson, you can get this, published, and we can make this like a real indicator that's easy to follow. It's a little bit tricky. I think that's what he's getting at.
I've published it to my own clients. I haven't published it in any academic journals. It's too time-consuming, but I will eventually. We're talking about two different topics here. The formula, go ahead.
If I want to go online, am I wrong, though? You take the price of gold today, 2050, you divide that by that ratio, right? But where do you get that index, though? I always, if I Google ICE B of A 30-year U.S. Treasury constant maturity strips index, that's what S030 is. Do you get that from ICE? Who gives that to you?
Yeah, they have a website. I can send you the link. It's very strict. And then you'll have to register in order to download data, but that's not hard and it's free. It goes all the way back to Merrill Lynch, and Merrill Lynch created that database, and it was free then, and I've been using it ever since.
It just seems to be tricky to find it sometimes. Would it be on the Fred website or no?
Well, there's something I need to make clear because we're talking about two different topics at the same time. One topic is the formula that I use to get the forward price of gold from the spot price of gold. The other topic has nothing to do with that. It has to do with the long-term proportionality between the price level or the inflation rate and the price of gold or the rate at which the price of gold goes up. And for that, you can use the spot gold price. It won't make much difference to the result. You're going to get a 45-degree straight line relationship across the entire world and within the United States historically as well.
Yeah, I just don't. I care about what's going to happen a year from now, 2 years from now. I get, but I find it pretty alarming that you said there was because of having you on, 58% change in this ratio last year that really hasn't shown up in the inflation numbers yet. And I remember you kind of saying this 3 years ago, and then it happened, and it's kind of alarming. But
well, the good side of the whole story is that the combined collective private sectors of the economy are far more powerful than we give them credit for. And the markets, where markets are efficient, are permitted to operate, they're far more powerful in dictating the future of a country like the United States than any bunch of Washingtonians would be.
And what is that? To go back to this ICE B of A thing, what is that number today?
Well, as I say, it's a 6-digit number. I
Oh,
I don't
okay, okay. And you just plot it
changes every
daily,
day.
and then you see
Yeah.
a rate of change. Okay.
Yeah.
Yeah, send me an email on how to get that. I've always found.
Yeah, I'll send you the link, and I can send you several data points so you can double check. You can download them.
And just to clarify this, you take the current price of gold and you divide that by that number. And that gives you a number, and then you just plot it once a day.
Twice a month.
Okay.
And even that's more than enough. But it shows this 160% increase.
And that rate gives an implied future inflation increase that has yet to show up in the economy.
Some of it has shown up. That's why we've had the inflation surge, but an awful lot of it is yet to show.
So if it was a 58% increase, just, rule, what hasn't shown up yet?
Well, the big part of what has not shown up yet is the way the oil price has pulled away from it, dragging a lot of commodity prices along with it. So as long as oil is abnormally priced, which it will be as long as we have wars breaking out all over the world, then oil will be depressed in price until we have a really hot war, then it'll go up.
What if the government, I mean, obviously they have some access to this data. What if they know this and they're just saying that's why we're flooding the oil markets to keep supply high so prices go down, like some manipulation. So for example, kind of the whole theory that the Biden administration made the reserves more plentiful, more available, things like that. You don't really look into that.
I don't look into that. There's no question that government officials are manipulating everything they can get their hands on all the time. But I don't think it makes a heck of a lot of difference. Markets are huge, deep, intelligent, far-sighted, and will outwit the government every step. And the market's estimate is the one I would go by.
What else is keeping you up at night? What are you researching lately?
Well, I'm getting into commodities generally. I think the same things I've been saying about oil are also true about other commodities, which are much less important than oil. But it makes it interesting if you can develop a way of anticipating what's going to happen to commodity prices. That's useful for investment strategy purposes. So that interests me as well. I would like to develop some kind of general theory of commodity pricing along these lines. And it won't depend on what the people are doing running the Strategic Petroleum Reserve, or the Saudis or the Russians or the Chinese or anybody else. It doesn't matter what individuals do. It's only a matter of what the market is doing.
So what do you like? What opportunities do you like right now in the investing landscape?
Well, the most interesting thing I do is to look overseas, and this is very counterintuitive. I look for the countries whose currencies have depreciated the most. Currently, that might be Argentina, might be historically would have often been Brazil, Turkey, Chile, and other countries from time to time. And this goes all the way back to the 1920s when the French started the whole ball rolling after the First World War. I look at these countries and I find that none of them can tolerate the hyperinflation that results. Politically, whoever was in charge during the huge currency depreciations that have occurred has been thrown out of office and replaced by somebody who looked like they might know something. And frequently, the new regime that came in didn't know anything, and the inflation just carried on. But once in a while, they did know something, and they stopped the inflation one way or another. As most notoriously, the Germans stopped inflation in 1923 with the help of a loan from the United States. The thing is, if you anticipate there will be a reliable political revolt against hyperinflation in any country, then you should buy the equities of that country. It's called buying the dogs. They are the worst performing equity markets, but once the currency is stabilized, they turn around and zoom back up. I'm hoping this is going to happen in Argentina. It may have begun, but there's a lot of other things going on in Argentina right now, and they haven't dollarized yet. But if they do dollarize, That'll happen to Argentina if the present president is lucky enough to survive the opposition, which is intense.
So, for those who are not familiar with Argentina, what's going on, and you write in the International Forecaster, tying the domestic currency to or replacing it with a more stable external standard is a prescription that many other countries will eventually follow. They are the latest country in successful political rebellion against high inflation. Talk about that a little bit more.
Yeah, people, I think, in the news media at least, and a lot of economists minimize inflation as really not that big a problem. It's the general public rising in revolt against it that convinces some economists that it must be more of a problem than they realized. The way to see how big a problem inflation is, one way, a very interesting way, I've just written about this, is to look at the stock market measured over 10-year periods. The 10-year performance of the equity market. I've got the data back to the 1920s, I guess. I could go much further back if I take the time. So we've got about, I think it's 9 decades in which we can measure the stock market's performance and the growth rate of the economy during that decade as well, and compare them. Hardly any connection. That goes against most people's intuition. There is a connection, but it's not what you think. Then you plot a graph of the 10-year stock market performance against the 10-year inflation rate. It's like an explosion, a huge correlation, especially if you replace the inflation rate with the change in the price of gold. Then you get the most unbelievably close relationship. If you wanted to explain 10-year stock market performance, which goes up and down like a yo-yo, it's not at all a safe asset, then the price of gold explains it to something like a 75% extent. So that's one of the things I've been doing recently, looking at 10-year horizons. It bears on this view in the United States that stocks are the asset to hold for the long haul. I don't believe this at all. 10-year stock market performance, and 10 years is a pretty long time, can be 20% per annum for 10 years, or it can be negative per annum for 10 years. It all depends on which 10 years you pick. That's not an asset you want to hold for the long haul and forget about. And there is no asset that you can hold for the long haul, perhaps except gold. There are hardly any other assets at all. And the stock market is just like all the others.
Have you looked at any other countries besides Argentina who are trying to have a political rebellion against inflation? For example, El Salvador with embracing Bitcoin as a more fixed external standard, things, other countries.
Well, there isn't time. I haven't looked at a lot of other countries until relatively recently. The best example you might not think of is Russia. Russia had virtually a hyperinflation coming out of the invasion of Ukraine. And the Russian inflation rate was pretty high before the Ukraine crisis occurred. And somebody must have persuaded Putin that they could tie the ruble to gold. Essentially, it's like Argentina dollarizing, Russia goldized it. And they did. It wasn't a mechanism. It's not clear how they did it, but they did keep the exchange rate between the ruble and gold within a narrow band, and they kept it going for about 4 months. And during that 4-month period, inflation went to zero. And then something broke. The Russian central bank was still there. They must have pushed the advisors who recommended this strategy out, and they went back to their policy, let the ruble float, and it floated down and down and down, and now we're back to hyperinflation again.
Parting thoughts, things that you didn't share with our audience that you would like to.
That's hard to think of and without any preparation, but I think my biggest thought is that, as I said before, markets give us tremendous amounts of information that we're not paying sufficient attention to. And government officials are giving us lots and lots of information to which we're paying far too much attention. That would be my parting thought.
And in another one of your, and you can find out more of Dr. Ranson's work at hcwe.com. My parting question, does it pay to buy bonds after dips?
I found the answer to be no. It may sometimes. There was a big dip in the bond market, as you know, about 6 months ago, I think it was. And it has come back. But I was studying it before it came back. I looked at all the historical bond market dips, and I found that unlike the stock market, the biggest dips were not followed by the biggest rebounds, and the smallest dips were not followed by the smallest rebounds. There was no proportionality between the dips and the rebounds. Whereas in the stock market, there's a very strong relationship between the severity of the so-called dips, which are really sell-offs, and the rebounds that follow them, which reflect the restoration of confidence. It does not work for bonds, but it does work for stocks, and it does work for quite a few other assets. It works for the oil market, and it works for other commodities, and that is something that I'm working on currently.
David Ranson, hcwe.com. Thank you so much for joining us, Dr. Ranson. Thank you all for joining us on X. Make sure you follow me for more. Have a great day. Great evening.
You too. Thank you.